Hey there, ladies and gents. Bratt, the real estate Jedi with Big Block Realty. I am making a video. I just made these 3 reports for a client of mine that is possibly looking to get off the market, save up for about a year, get some money for a down payment, and then buy back in. And I just made 3 different scenarios for him just to look at the interest rate potential. If interest rates were to just go up a slight bit, whether it's a quarter point, half point, a full point, whatever. And I just wanted him to see the perspective that interest rates actually have in addition to the variance in price. So this is just strictly looking at interest rates. What we have here is 3 different scenarios. $500,000 fixed rate mortgage for 30 years, 360 payments, fixed rate, no adjustments, no balloon payment, and just 3 different interest rates. So 3.25, 4%, and 5%. And I just want to give you a quick snapshot of how much this little thing impacts such a tremendous amount of things, because everybody's often focused just on the purchase price, it seems, and geez, that's only half the story. So if you take a quick look, the one over here on the left is the 3.25, this is 4%, and this is 500. And now if we look here at this graph quick, this curvature here, the red is interest and the blue is principal. This is over the span of 360 payments. And you can see that as the payments go on, the majority of the payment begins going towards principal. And then as payments go on, less and less goes towards interest. So that's obviously a good thing. Now, the thing to keep in mind, though, is look at this crossover here. This is at payment 105, and this is for the 3.25 rate. And over here at 4%, this is for the 4% rate, and the payment crossover is 153 payments. And then over here, it's for 195. So if we look at this, 105 divided by 12, that's just under 9 years in, and more of your payment is going towards principal, paying down your balance, than it is for interest. Over here, just 3/4 of a point more, 153 payments divided by 12, that's just under 13 years. So it goes from 9 to 13 years that you have to wait before the majority of your payments going towards principal. And then finally, you get the idea, 195 divided by 12 over 16 years over here. Now, the interesting thing is, look at this though. Again, we have the same loan balance, starting off loan balance. The payment here is $21.76. Look at the amount going towards interest, $13.54, principal, $8.21. Look at this. Let's just compare the 2 extremes here. Over here, you have payment $26.84, interest $2,083, and $600 is going towards principal. Only $600. So you have a payment of about $500 more per month here than you do here, but $200 less, over $200 less is going towards principal. So what's that mean? Let's look at 5 years in. The average person, homeowner, either sells or refinances every 5 to 7 years. I find that close to be 5, it seems, in California lately. So let's just look at this. I don't know how to get rid of this side thing. Oh, there we go. All right. So let's just look at this. This is after payment 59. Again, for 3 different scenarios. So 3.25, your total payment that you have made for principal and interest has been $128,000. For 4%, it's $140,000. And for $158,000 for 5%. And look at this, the principal pay down, $40,000 for the 5% and $52,000 for this. So something I always got mixed up, I think, until several years back. I just had a kind of, geez, why didn't I see this before moment? But I always kind of thought that, okay, cool. So higher interest rates obviously mean higher payments, but at least your principal pay down is the same. It's just that you're paying more interest throughout. And that's just simply not the case, because if you look at this, you have a lower payment. Your total payment every month at 3.25 is $21.76. Look at this, $26.84 total payment on your 5% minus $21.76. You're paying over $500 more a month on a 5% rate for the same balance as you are for a 3.25% rate. But look at this. This property's got more equity in it. This one, you've paid down $52,000 of your principal, and this one you've only paid down $40,000. I mean, that's incredible. So you've paid down $12,000 more. $12,000 divided by 40,000. That's 30% more principal pay down here than over here. 30%. And you thought you only had a one and, however many, how much higher of a mortgage, of an interest rate. No, you paid down 30% more principal here than you did over here. Same everything else, folks. And that's not even calculating it. So, I mean, this is just one of the angles to try to reason whether or not it makes sense to save up for a year so you can put a down payment down, a higher down payment down. Because that's not even considering that in San Diego County, okay, in the last year, the appreciation rate's been 8.1%. So let's go off $500,000 property times, times 1.08. That's $40,000 right there. Geez, and what's $40,000 more in purchase price? Even if you're putting a $30,000 down payment down, you're still probably, even if you put the same amount of down payment down, now you just spent that money, and but you're paying this much more with a higher interest rate if rates go up. Again, no guarantee rates are going to change one way or the other, but in the grand scheme of things, 5% would not even be that high of a rate. So 3.75, 4.25, as we're seeing right now, that's pretty darn good. So even if it goes up to 4.5, 4.75, you can just see the general impact that such a small change in interest rates make. So it's not just your payment, it's not just your purchase price, and it's not just the interest rate that raises your payment. It's what you need to understand, though, is it's not just the interest that's higher, it's that the principal pay down is lower. So that equates to a much higher difference payment. If you calculate in the difference in the payment of $500, that's not the total story. You got to calculate in the additional $200 in difference in the principal pay down. So that's actually $700 difference a month in your payment and what actually it's costing your pocketbook. So hopefully that was helpful. Hopefully that makes you think of things a little bit deeper. And if you have any questions about the real estate market in San Diego or why you should buy or sell, let's talk. 619-750-2751. Jed Bratt, Real Estate Jedi, signing out.